Hey everybody, Luke Gromen, FFTT. Hope everybody had a great weekend. I know I did. I was down at the University of Cincinnati, my alma mater, with my oldest son, who actually also goes there. We were watching the Bearcats play the Navy midshipmen, and we won. The Bearcats won. It was really cool to see how well Navy traveled. It really surprised me. A lot of Navy fans there, a lot of cadets there, some that we talked to that drove all the way there from Annapolis. So much respect to those guys, both for their traveling and for their service, most of all. So with that, we're going to jump right in. First off, from SW, previously you said Q3 would be the pivot or pause. Do you have a new pivot or pause timeline? No. Clearly, we were wrong. They didn't pause by virtue of the rate hike last week. Many of the things I thought that would happen, that would force a pause, happened. Sovereign debt dislocations that we've seen year to date, energy markets rolling over at least off the highs by a good 20-30%. Stocks down, Treasury market volatility. However, the Fed didn't pause in response to those things, which surprised me. I still think the U.S. fiscal situation will be a trigger. I think a potential trigger may have been the borrowing update from the Treasury last week when they announced a doubling in the annualized deficit over the next 6 months. I don't get the sense a lot of people have noticed that. I think it was a very important data release. All else equal, if the Fed prints enough, it'll put downward pressure on the dollar. Basically, what it's going to do, much higher deficit is going to put upward pressure on the dollar, upward pressure on Treasury yields, unless more liquidity comes in from either the Fed or the Treasury. There were some other questions about what are other potential triggers that could cause a pause or what we may have missed in that call. I think you need to see a bigger hit to the economy. I quite frankly have been surprised, and I'm scratching my head a little bit about the Atlanta Fed GDP number at 3+. It is what it is. It doesn't really make sense to me given some of the other data we're seeing, but we'll see how that plays out. I think also, I think it's noteworthy to note how the TGA or Treasury General account, the Treasury's checking account, effectively has been run down in the weeks leading up to the election. That is to say that over the last, I was told that the TGA has been run down by about $100 billion over the last month or so, about $85 billion in a little over a week. So that's a lot of dollar liquidity into the system that, shame on me, I probably should have factored ahead of an election, but did not. I do think it's important from the standpoint that there's a finite amount in the TGA. And as a result, we should get a cleaner read on markets post-election, because presumably the rundown in the TGA that's basically been sterilizing Fed QT for a month, that rundown in the TGA should begin to be reduced or stop, to be more direct. Next question from DG. How do you assess sovereign risk when allocating your gold miner positions? Quote unquote, another described miners as a near useless investment because gold won't trade for a time, which would allow governments/sovereigns to craft new legislation on gold mining profits, taking most of the upside away. For me, I think if you want to own gold, you should own gold, physical metal, held out of the system in private storage facilities that are around the world and around the U.S. I do have a good-sized gold miner portfolio as well. My base case is that there isn't going to be seizures or nationalizations in the Anglo-American sphere in particular. I think that risk is higher in other jurisdictions. However, I do think there is a tail risk that you could have your upside kept by the governments, even in the Anglo-American judiciary nations. By that I mean, let's say we wake up, gold's repriced at $5,000 per ounce. The first $1,500, so call it to $3,000, would accrue to the miner. Everything else above that would accrue to the government. I think that's a tail risk. That is not my base case, and I think it's critical to note that at that level, or even levels below that, where the cap price would be, the leverage to the miners would be extremely high, and so it'd still be very favorable for the miners. I just think it's something, as you think about allocations, it is something to consider. I think it is a tail risk, and we have seen some things, obviously, in Canada in particular in the last year that have changed, certainly, my view on how big a tail risk that is. I would say the tail got a little fatter on that for different Canadian properties. I still think it is a far out tail risk. From LS, what are your thoughts on the outlook for uranium miners compared to oil and gas equities over the next decade? Any other energy sources you're particularly bullish on? I don't have any opinion on the uranium miners against oil and gas. I've simply never spent the needed amount of time to understand that business well enough. I do think energy, broadly defined, is a secular outperformer in coming years due to peak cheap energy in the fossil fuel sector. It should drag all sources of energy higher, as long as you don't have a really apocalyptic view of the future, because energy demand should continue to rise in coming years. And so for me, I like energy broadly defined: nuclear, uranium, fossil fuels, coal, ag, electric vehicle metals. And then I think, too, the neutral reserve assets that serve as effective stores of energy, preservers of energy purchasing power, which historically have been gold. And I think Bitcoin fits that as well. From PM, is it a good time to get into long-dated treasury bonds? And how do you see their performance in the next few years? Has the bond era ended for good? I do not think the bond era has ended for good, but I don't think it's time yet to be buying them, with an important caveat. For me, if I had a mortgage at a low rate, for example, if you, in the last year and a half, last year at this time to earlier, if you were able to get into a mortgage with a fixed rate of 2.75, 3%, something like that, then I think it would make some sense to take some portion of or all of your mortgage principal or property principal and put it into treasuries, long-dated treasuries, at a rate above the rate of your mortgage. And you can basically make yourself a bank, earn a positive spread. That, to me, to the extent you're doing that, that to me makes sense to own treasuries. Other than that, to me, it still doesn't make sense yet, because right now the only way, given where debt is, deficits are, the only way they can be made money good is by either having those treasuries restructured or having the Fed increase QE again. And so if the Fed increases QE, or the Treasury does a buyback, or there's some basically liquidity injection, yes, I think treasuries could go up, absolutely. With that said, it's a suboptimal expression of that increased liquidity to play that by buying long-dated treasuries. To me, the better ways of doing it: owning gold, owning Bitcoin, owning commodities, owning industrial, some of the things we've been talking about. So what would make me want to be much more bullish on treasuries, if we got the sense that the U.S. government was set to slash U.S. defense spending, slash U.S. entitlement spending by 30, 40%, big numbers, which I think has virtually zero chance of happening. But if they were to do that, then I think you have to start thinking about, then I think longer-term treasuries make a great deal of sense, because now you're looking at a system where, at least in the short run, the U.S. government would be willing to impart significant pain on the economy, significant pain on itself, in order to preserve the real value of the bond market for a little bit longer. Those kind of cuts would create bigger problems down the road, but one step at a time. If they did that, then that's the kind of thing it would take for me to get more interested in treasuries on their own, to the detriment of other assets. From NP. Everyone is focused on a Fed pivot. Other pivots include oil energy production strikes due to geopolitics, or China reopening up fully, among others. Does the Fed still have primacy in directing the play, or is this now a three-body problem? It's a good question. I think it's now a three-body problem. You've got spot energy shortages in parts of the U.S. Or in the EU would indict sovereign debt or debt markets more broadly in some capacity. That would represent sort of a change of the rules versus just Fed having primacy to the rules of the game. Olaf Scholz visiting in China. You're seeing China's Xi make plans to go to Saudi Arabia. You see OPEC cuts at a time when the U.S. was asking OPEC not to cut. These are rule changes that, in my view, point to it being more of a three-body type problem. That the Fed is no longer sort of the sole decider of how things are going to go. I think petroleum geology gets a say. U.S. Big Four shale production needs to rise by 400,000 barrels per day per month, give or take, just to stay flat. Compounding interest gets a say when you've got energy issues and you've got debt to GDP this high, deficit issues this high. So I think there are other factors at play than just the Fed. And so I think it's a good point that you make there, NP. And then from NT, with U.S. dollar relatively high across all markets, what are the chances the Fed keeps increasing without breaking the stock market and real economy? Also, if Fed keeps increasing rates, would we see another 2008 real estate drawdown? In my opinion, the odds that the Fed can just keep going and strengthening, raising rates, driving the dollar higher in part, without breaking something domestically, stock market and real economy, are very low. With that said, as it relates to the real estate question, I don't think the problems are centered in real estate. I think the problems are centered at the sovereign level. So I think you're already seeing strains in global sovereign debt markets, the volatility in the treasury market being as elevated as it is. This is where I think the issues are. You're seeing it in what they say called duration, right? It's the bond market is sold off. It's almost all duration. It's not spreads. It's duration. It's the underlying, which is what they're effectively saying is the issue is at the sovereign debt level. So with that said, higher rates because duration is selling off is not good for interest rate sensitive asset classes like housing, residential real estate. So I don't want to leave you the impression it won't be problematic. I don't think a lot of the I think it's very different than it was in 2008 in terms of some of the craziness is no longer there. You don't have the ninja loans, no income, no job loans, low doc loans that you had leading up to 2008. They are much more robustly underwritten. So I don't think it's the same problem there. I don't think that's where the center of the problem is going to be. But that's not to say you won't see housing and related markets suffer if the Fed if the Fed keeps tightening. I think you will. So at any rate, with that, I'm going to finish up for today. As always, I appreciate you joining me. And if you like these updates, check us out at FFTT-LLC.com. You can learn more about our different product offerings, including tree rings, 10 most interesting things, what we find interesting about them, how they either confirm or refute a way we had previously been thinking about the world. And in the meantime, everybody have a great rest of your week. Look forward to talking with you soon. Take care, everybody.